In this video, we are going to discuss the importance and practical uses of the weekly time frame. Once you fully understand this concept, you will be able to identify market direction much more easily. So without wasting any time, let's dive straight into it. So, to begin, in order to understand and determine the formation of the weekly candle, you first want to analyze the economic calendar for that specific week. This is a step that most traders completely ignore. But in reality, it plays a major role in how price is delivered throughout the week. You need to clearly understand which days have no news and which days have high-impact news, because these are the days that inject volatility into the market and create the moves we are looking to capitalize on. Every first Friday of the month is non-farm payrolls, and during NFP weeks, the market tends to behave in a very specific way. What you typically want to do is position yourself early in the week rather than chasing price later on. For me personally, if Monday has little to no news, I usually stay out of the market completely because price tends to be slow, indecisive, and often sets up liquidity for the rest of the week rather than delivering the actual move. Instead, my main focus shifts to Tuesday and Wednesday. These are the days that sit in the middle of the week and come before NFP, which means they often provide the cleanest and highest probability setups. Thursday is a day I typically avoid because it is right before NFP, and price can become very erratic or simply consolidate in preparation for the major release. Then on Friday, which is NFP, price usually delivers large expansion moves. But unless you are specifically experienced in trading news, it's not always the best environment for consistency. So overall, the highest probability trading days during an NFP week are Tuesday and Wednesday, and that's where I focus most of my attention. Now moving on to the dollar index, we begin by analyzing the monthly time frame. At first, this is just a clean, naked chart so we can observe price action without any bias or annotations. Before marking anything, you should already be training your eye to identify key concepts such as where internal range liquidity is, where external range liquidity is resting, and most importantly, where price is likely to draw next. Once we bring in the annotations, we can clearly see that price ran a set of relative equal lows, which represents external range liquidity. After taking that liquidity, price expanded to the upside into a monthly bearish fair value gap, which now serves as our internal range liquidity. In the process, price also took out the relative highs, completing a full range expansion. From this movement, we can define a monthly dealing range from the swing high down to the swing low. Following that expansion, price retraced back into a monthly bullish order block, positioning itself in the discount portion of the dealing range. This is a key observation because when price is in discount, we are generally looking for buying opportunities, especially when there is a clear draw on liquidity sitting above. Now dropping down to the weekly time frame, we apply the exact same concepts but with more refined detail. From this perspective, we can see that price ran a weekly swing low, which represents weekly external range liquidity. This also aligns perfectly with the tap into the monthly bullish order block in discount, giving us strong higher time frame confluence. Once external range liquidity is taken, the expectation is for price to retrace and move toward internal range liquidity. In this case, that internal range liquidity is the weekly bearish fair value gap resting above price. This level now becomes our draw on liquidity for the week, effectively giving us our weekly bias and directional narrative. Now that we have established where price is likely to go on the weekly time frame, we can drop down to the 4-hour chart to understand the structure that will deliver that move. On the 4-hour time frame, once price ran the weekly external range liquidity, we saw a clear bullish shift in market structure. This shift actually occurred on the Friday of the previous week, which is important because it sets the tone for the upcoming week. After that bullish shift, price retraced into the discount portion of the 4-hour dealing range. Despite this retracement, the overall draw on liquidity remains to the upside, targeting the weekly bearish fair value gap. This alignment between the higher time frame bias and the 4-hour structure gives us confidence that we should be looking for buying opportunities rather than selling. Finally, dropping down to the 1-hour time frame, we refine our execution. Here, I divide the chart into individual trading days, marking Monday, Tuesday, Wednesday, and Thursday. Since Monday is typically a low probability day, I use Tuesday as the true starting point of the trading week. Focusing on Tuesday's price action, we can observe the presence of volume imbalances and new day opening gaps. These inefficiencies in price act as areas where the market can find support during retracements. Additionally, I mark the 10 a.m. high-impact news, which serves as a volatility injection into the market. As price reacts to this news event, we begin to see bullish momentum enter the market. This momentum is not random, but rather a delivery mechanism pushing price toward the higher time frame drawn liquidity. Price continues to move higher, eventually taking out buy-side liquidity and delivering into the internal range liquidity, which in this case is the weekly bearish fair value gap. This entire process shows how the market moves in a very structured and logical way when you align the economic calendar, higher time frame liquidity concepts, and lower time frame execution. Once you understand how these pieces fit together, you are no longer reacting to price, but instead anticipating where it is most likely to go next. And that's exactly how you can utilize the weekly time frame in your trading to build a clear directional bias and understand where price is most likely to draw. When you start with the weekly, you're no longer guessing. You're framing the entire week before it even unfolds, and that gives you a massive edge when you drop down to the lower time frames for execution. The weekly time frame isn't for entries, it's for narrative, it's for understanding liquidity, and it's what allows you to stay on the right side of the market instead of getting caught in random intraday moves. If this helped you understand how to actually use the weekly time frame properly, make sure you like, share, and subscribe. And I'll see you in the next one.